most common paths to building real wealth in the modern world are owning stocks and owning real estate. And if you spend any time in financial communities, you will find passionate advocates on both sides of this debate. Real estate investors will tell you that stocks are volatile, that you cannot live in a stock, that real estate generates cash flow and appreciation and tax advantages all at once. Stock investors will tell you that real estate is illiquid, maintenance-heavy, geographically limited, and that the long-run returns of a diversified stock portfolio match or exceed real estate without any of the headaches. Both sides make genuinely good points. Both sides also tend to cherry-pick the data that supports their position. This video is going to do something different. Instead of picking a winner, it is going to show you the actual evidence on both sides, walk through the real numbers, and give you a framework for thinking about which asset class or which combination of both actually makes sense for your specific situation, because the answer is almost never one or the other. It is usually a question of which, how much, in what form, and at what point in your financial life. Let us start with the historical returns, because that is where the debate usually begins and where most of the confusion lives. The stock market, measured by the S&P 500 index, has delivered an average annual return of approximately 10% per year since its inception, or roughly 7% per year after adjusting for inflation. These numbers are long-run averages and include periods of dramatic loss, including the 2000 dot-com crash, the 2008 financial crisis, and the 2022 bear market. The volatility is real, but so are the returns. Real estate returns are more complicated to measure because there is no single index that captures all of real estate the way the S&P 500 captures the broad U.S. stock market. Different types of real estate in different markets in different eras produce very different returns. But Robert Shiller's research on U.S. residential real estate prices going back over a century found that inflation-adjusted home price appreciation has averaged somewhere between 0 and 1% per year. That number shocks most people. It is dramatically lower than what most homeowners believe they have experienced because they tend to remember the nominal price gain without accounting for inflation, maintenance costs, property taxes, insurance, and transaction costs. So does this mean stocks are obviously better? Not quite, because there is a crucial factor that the raw appreciation comparison misses entirely when it comes to real estate. Leverage. When you invest in the stock market, you typically invest your own money. If you put $50,000 into an index fund and it grows at 8%, you earn 8% on $50,000. Your return is a function of your capital. When you buy real estate with a mortgage, you put 20% down and control 100% of the asset. If you buy a $400,000 property with $80,000 down and it appreciates 5% in 1 year, you have made $20,000 on an $80,000 investment. That is a 25% return on your actual capital, not a 5% return. The bank's money worked for you. This leverage effect is one of the most powerful advantages real estate has over stocks for wealth building. It allows you to control large assets with relatively small amounts of capital and earn returns that are not just on your money but on the full value of the asset. But leverage is a double-edged tool. The same mechanism that amplifies your gains amplifies your losses. If that $400,000 property drops in value by 10%, you have lost $40,000 on an $80,000 investment. That is a 50% loss on your capital, not a 10% loss. The 2008 housing crisis showed exactly what happens when leveraged real estate investments go wrong at scale. Millions of homeowners found themselves underwater, owing more on their mortgages than their properties were worth, with no way to exit without taking a catastrophic loss. Now let us talk about cash flow, because this is where real estate's most compelling advantage lives. A well-chosen rental property generates monthly income. After paying the mortgage, property taxes, insurance, and maintenance, a profitable rental property produces positive cash flow every single month. That income does not require you to sell the asset. It does not require the market to be doing anything in particular. It arrives as long as you have tenants paying rent. This cash flow characteristic is fundamentally different from what stocks provide in their basic form. Dividend-paying stocks do generate regular income, and historically, dividend-paying stocks have produced strong total returns. But the yield on most dividend stocks is typically in the range of 2 to 4% annually, which is meaningful but generally lower than the cash-on-cash returns that a well-managed rental property in a favorable market can produce. Real estate investment trusts, commonly called REITs, offer a middle path. They are publicly traded companies that own and operate income-producing real estate and are required by law to distribute at least 90% of their taxable income to shareholders. REITs allow you to get exposure to real estate returns, including cash flow, without the illiquidity, the maintenance responsibility, or the large capital requirements of direct property ownership. Historically, REITs have delivered total returns that compete with the broader stock market while providing income yields significantly above what most stocks offer. Now let us look at taxes, because this is one area where real estate has a genuinely significant structural advantage over stocks. Real estate investors can deduct mortgage interest, property taxes, insurance, and maintenance costs against their rental income. They can depreciate the value of a property over 27.5 years, creating a paper loss that reduces taxable income even when the property is actually gaining value. When they sell, they can use a 1031 exchange to defer capital gains taxes indefinitely by rolling the proceeds into a new property. And if they hold property until death, their heirs receive what is called a stepped-up basis, which eliminates the accumulated capital gains entirely. Stocks have their own tax advantages. Long-term capital gains are taxed at rates significantly below ordinary income in most cases. Tax-advantaged accounts like 401k plans and IRAs allow stocks to compound without annual tax drag, but the suite of tax tools available to real estate investors is arguably broader and more powerful for high earners. Let us now address the factors that favor stocks over real estate. Liquidity. If you need your money from a stock investment, you can sell it in seconds during market hours and have the cash in your account within days. If you need your money from a real estate investment, you are looking at a process that takes weeks to months, costs several % in transaction fees, and may require accepting a lower price if you need to move quickly. For investors who may need access to their capital, this illiquidity is a significant disadvantage. Diversification. A single rental property is a concentrated bet on one building in one neighborhood in one city. If the local economy struggles, if the neighborhood deteriorates, if the specific property has major structural issues, your entire investment is exposed. With stocks, a single index fund can give you ownership in thousands of companies across dozens of industries and multiple countries, spreading risk in a way that is simply not possible with direct real estate ownership. Management burden. Owning rental property is not passive income in the way that the phrase is often used. It requires finding and vetting tenants, managing maintenance and repairs, dealing with vacancies, navigating landlord-tenant law, and either spending your own time managing these responsibilities or paying a property manager, which typically costs 8 to 12% of your rental income. Stocks require none of this. You buy shares and they compound. No midnight calls about a broken pipe. Scalability. It is relatively easy to increase your stock portfolio in small increments. You can invest $50, $500, $5,000, whatever you have available in a given month, and it all compounds at the same rate. Real estate requires large, lumpy investments. Each additional property requires a new down payment, a new mortgage approval, a new due diligence process. Scaling a real estate portfolio is possible, but it requires significantly more capital, expertise, and effort than scaling a stock portfolio. So which actually makes you richer? The honest answer is that both can, and that the research does not give one a clean victory over the other over long periods. A landmark study published in the Quarterly Journal of Economics by economists Skar Yorda, Katharina Knoll, Dmitry Kuvshinov, Moritz Schulerich, and Alan Taylor studied returns across 16 developed economies over roughly 150 years. Their finding was that housing and equities have delivered remarkably similar total returns over the very long run, with housing generating slightly higher returns in some periods and equities in others, and both significantly outperforming bonds and other asset classes. What the study also found, importantly, was that housing's strong performance was heavily dependent on local market conditions, and that the variance in housing returns across markets was dramatically higher than the variance in stock returns. The best real estate markets massively outperformed stocks. The worst real estate markets massively underperformed them. Stocks, by contrast, delivered more consistent returns across the board. This is the key insight. Real estate's returns are more dependent on the specific decisions you make, the markets you choose, the timing of your purchase, the type of property, and your skill as a manager and operator. Stocks, particularly index funds, democratize strong returns for anyone who simply participates in the market consistently over time. So what is the right approach for you? If you are early in your wealth-building journey with limited capital, stocks, specifically low-cost index funds in tax-advantaged accounts, are almost certainly your most efficient starting point. The low minimum investment, the diversification, the tax advantages, and the compounding power make them the highest leverage use of small amounts of capital. As your wealth grows and you develop more capital, real estate, either through direct ownership of rental properties or through REITs, can add meaningful diversification, cash flow, and tax advantages that complement a stock portfolio. If you have genuine interest in real estate as an operator, if you enjoy the process of finding properties, managing renovations, optimizing for cash flow, and building a portfolio of income-generating assets, real estate can be an extraordinary wealth-building vehicle. The leverage and the tax advantages make the math very compelling for skilled operators in well-chosen markets. If you have no particular interest in the operational side of real estate, and simply want your money to compound efficiently without ongoing demands on your time, stocks and REITs are probably the better fit. The people who build the most wealth are rarely those who picked the perfect asset class. They are the ones who started early, stayed consistent, avoided catastrophic mistakes, and remained invested through the volatility that comes with any long-term wealth-building strategy. Whether that strategy involves stocks, real estate, or both, the habits that make it work are the same: patience, consistency, and the discipline to let time do the work that trying to be clever almost never can.